All right, good morning, everyone. It is 8:30 in the morning of October 17th, 2022, and this is my pre-market strategy session. Today's video is titled 10-2 Yield Curve Inversion and Subsequent Market Declines. All right. And what you're seeing on your screen right now is a chart of the 10-year yield minus the 2-year yield. So, in what I guess you would call normal market situations, the 10-year yield is greater than the 2-year yield. However, when the economic conditions appear to be forecast for tough times, the money will go into the 10-year yield. Demand for the 10-year yield will increase, which drives down its yield. People are willing to pay more for a bond. So if a bond sells for $1,000 and it yields 4%, but then there winds up being more demand for the bond. So instead of the bond selling for $1,000 on the open market, it sells for, let's say, $1,100, which is really quite a large premium. That drives the effective yield down. So instead of buying, $1,000 bond that yields 4%, in essence, if you buy a bond that costs $1,100, it still yields 4%, but instead of it yielding, well, it'll still return 4% on 1,000, but instead, let's see, it's been a long time since I've done the bond math, but essentially, what you've got here is, let's say, 1,000 times 0.04 on an annual basis, right? Comes out to $40, right? Now, if you take that and divide it by 1,100, and this is very, very rough. There's a much more. It's just been a long time since I've done the math on calculating equivalent yields and so forth. But then this is roughly speaking. If I buy that same bond that yields 4%, but I pay $1,100 for it, instead of getting a 4% yield out of that bond, I'm getting a 3.6% yield out of that bond, right? So, and just to kind of do that again, $1,000 bond that yields 4% divided by 1,000 gives you 4%, right? $40. Hold on to it every year, gives you $40 per year. But if you pay $1,100 for that same 10-year bond, this is the yield that you can expect over the course of 10 years. And the reason that people do that is it's a flight to safety. It's a safe place to put cash. The 10-year bond trades. It's very liquid. The bond market is enormous. The stock market is huge. I think the bond market is multiples in hundreds of times larger, if not thousands of times larger than the stock market. So money's coming out of the market and going into bonds, and it gets to a point where it's a flight to safety. Now, what I'm getting into in this video is the example from 2001 and 2007. And what happens here is you can see the yield curve goes negative. So the 10-year yield, people are willing to pay so much for the 10-year yield, for the 10-year bond, that it pushes the yields lower than the 2-year bond. And actually, the 2 years, I think that's let's see, there's bills, notes, and bonds. I think the 2 years a note. I don't remember exactly. There's a time frame for the difference between bonds, notes, and bills. I think bills are the shortest term. But anyway, so what you have here in this green circle down here, this pink line is the zero line. So at the zero line, the 10-year and the 2-year are yielding the same amount. Below that, the 10-year is yielding less than the 2-year. In this example in 2001, let's see, it lasted for approximately a year. It may have been a little bit longer. I'll put it on the monthly chart. Let's see. Let's count the months here. So back here, it went into inversion. I'll call it back here in December of 88. Oh, this is all the way back in 90. Let's get back to the 2001. There's another crash back here, but I'm not going to cover that one. It's the same thing. The same thing winds up happening. It's just that I wasn't paying attention to the markets back there. I was just too young to really pay much attention to it. So anyway, back here, let's see. It goes inverted, closes inverted in February of 2000, and then normalizes, starts to normalize again in a year later, in January 2001. And I actually, on this chart, let me go to the day. Let me go. I have it. Let's see, that's February 2020. Let's go back. Let's go back. That should be 2001, yeah. So the day that the yield curve started to normalize, I have it as Tuesday, the 2nd January of 2001. And what I'll do is I'll go back and I'll look at the SPY. This is a proxy for the S&P 500. It's an exchange traded fund that's a proxy for the S&P 500. This is the monthly chart right here. Let me go back to the daily chart. And let's go back. Let's go back. Let's go back. Let's go back. That's 2007. Let's go back to 2001. So the market started to roll over prior to the yield curve normalizing. Yield curve going back in a normal, configuration where the 10-year yields more than the 2-year. The day that the yield curve normalized, again, I have as I think actually on this chart I have as Wednesday 2000, Wednesday the 3rd, 2001. Let me go back over here. Yeah, Wednesday the 3rd, 2001. This is the 10-2 chart right here. And I'll get that, let me get that horizontal line out of the way. Let's see, it's one of these over here. There it is. So you can see that blue line is popping up to pretty much the date that the yield curve starts to normalize again. And subsequently, you can see the downturn in the market. In this box right here, from that date, now, there had already been, I don't know, a bit of a downturn. I guess I can measure it here. Let's see, from absolute peak to that day, there had already been about an 18% downturn in the market prior to the yield curve normalizing, right? Well, after it started to normalize, we got another 43% downturn. This orange box right here you're seeing is a tool in order to measure price range, and it gives me the absolute terms. It dropped 57 points at that time, or $57 per share on this ETF, which represents roughly a 43% decline from where the yield curve started to normalize again. So the market rolled over, and I guess from top to bottom, it came around somewhere around 60% or so loss on the SPY from top to bottom. And then the same thing can be shown here in 2007, the housing bubble. In this case, the yield curve inverted, came back up out of inversion, and there was a tiny back here. Let me move this brush mark here real quick. I gotta find it first. This bubble, there it is, that bubble right there. So you can see right in here, the yield curve came out of inversion, and there was a corresponding little downtick in the market with this inversion, with this sort of movement back above inversion. And then it went back inverted again, and the market continued to go up for a while. Now, here on the 30th of May 2007 is the date that I have. The blue line going up and down is the date that I have for the yield curve normalizing. And that's the day that it kind of popped up and stayed up. Actually, let me move that. Actually, it looks like it's more like the 6th of June 2007. So let's go back over here to the 6th of June 2007. So Monday. Let me get off of January here. Let me move that back to the proper date. Wednesday the 3rd. Now let's go back over to 2007. So, and let's go to the 6th of June instead of the 31st of May. All right. And so this is the date that it started to normalize. And I'm going to move this over to the 6th of June. So here's the close. Here's on the 6th of June. Actually, I'll go to the open. So here's the move from the 6th of June when the yield curve started to normalize back here. There's a lot of squiggly lines and stuff. But you can see this is the last day. This blue line right here covers the last day that the yield curve was negative for a sustained period of time. So it went positive. It went positive on this day after the 6th of June and stayed positive and started to normalize from that point forward. And after that point, that's when we started to see the significant. Now, the SPY did pop back up again above this range, above that price range again. But from that point forward, I mean, that really represents, the high. And this led to a subsequent almost 56% downturn on the S&P. So that's 2001 and 2007. And the reason that I'm doing all of this is to bring us forward to where we are right now. So here we are. The yield curve is inverted. Now, as far back as this chart goes, let me go to the monthly. This chart goes back to as far as late 1988. And the greatest level of inversion that this chart has historically, and it could go deeper than that if I go further back, but who knows. For these purposes, I'm just going to use this one. There was a negative 0.699 on the 10-year, 2-year inversion. So that as of right now, 0.699 is on the record as being the deepest 10-2 yield curve inversion. And so here we are dropping down into, pretty darn near that level, right? And here we are. Let's go forward here. Forward. Here we are now. This is where we are in the S&P. So you can see the S&P's definitely already started to roll over. In fact, there's almost, I think, a 30% move from top to where we are right now. Let's see real quick. I'm going to put the top right there in January of 2022 and where we are right now. So we are at 25.63% to the downside as of right now. And so, once this yield curve starts to correct again, now these conditions, like you can see back here, again, this is the monthly chart. So these inverted conditions can last for a year and a half before they start to correct again. And so we are still due for a major correction after this yield curve starts to normalize again. And given that we're starting, somewhere around 24%, 25% down already, it's really quite possible to see another 50% from wherever the market is once it starts to normalize. So, I mean, if suppose for a moment, the S&P is at, or the SPY here is at 280 or 300 in another year or so, then it's really quite likely that there's nothing to say that we won't go down to 150 once the yield curve starts to normalize. So this things are looking pretty tricky for us. And in addition, so since I kind of do this for trading on a daily basis, I'm going to throw a Fibonacci retracement. So this is the low from 2020 to the peak in 2022. And it's really, it's no coincidence that there's been a 50% retracement of this move from 218 to 400 and almost 80. I'll call it 480. There's been a 50% retracement. So at 349 roughly, look at the way it bounced right off of that. That was the 13th of October. That was Thursday, I think. Yeah, that was Thursday. I mean, it hit that 50% level right there from this move from here to here, from we'll call it late March to 2 years or almost 2 years later to early January of 2022, and it hit that 50% mark right there and just boom, just launched. Now, Fibonacci retracements aside, there's just so much that affects the market, but some things that just aren't coincidence. It just doesn't happen that way. So here we are. If we do this in reverse, I'm going to take this Fibonacci off right here, and I'm going to retrace it in reverse. Let me go to the monthly so it's a little bit easier. I'll go to the weekly so it's a little bit easier to retrace. I'm going to go from absolute peak. I should do closing, but once the difference becomes insignificant on closes. So again, here you can see that really a perfect bounce off of the 50% level. Actually, I said I was going to do it in reverse, so let me do that in reverse. From here to here. So here's the 50% level right here. It's not out of the question for us to, if we break down below this 218, which is not out of the question by any means. Once this yield curve starts to normalize again, and I seriously doubt we're